lot of misses today. What does it all mean? Let's get a closer look at some of the stocks worth watching ahead. I've got David Lowery, equity analyst with Faraday Research, who joins me now in the studio. Good to see you, David. What does it mean, all this weakness in results, these misses that we're getting?
Well, I think, to be honest with you, it seems like expectations maybe just ran ahead of themselves a little bit. And obviously, the economic environment is still very, very tough at the moment out there for a lot of companies. And I think you're just seeing the harsh reality of that growth across Europe and the UK and the US is kind of stifling a little.
But we had expected to see weakness in the second quarter. We saw it in the growth figures from companies. We knew we had the Japanese earthquake to contend with. So you say expectations may have gotten ahead of themselves. What about going forward? What are you hearing from these companies in terms of sustainability and the outlook for the rest of the year?
I think it's still very, very uncertain at the moment. Obviously, things are still very, very tough. Consumers in particular are still finding things very, very hard. They haven't got as much money to spend as they had previously. And I think that although people are missing, companies are missing their earnings forecasts, it's maybe the analysts who kind of didn't drag their numbers down far enough then is what you kind of maybe expect from that. And I think a lot of companies are still really unsure of the outlook, so their outlook statements are just reflecting that.
Well, this is one of the reasons that companies have used for sitting on bucket loads of cash, as many of them are. What do you think we're going to see in the second half? More of this sitting on their hands? Do you think we're going to get more pressure for them to return it to shareholders, more acquisitions? Is that going to be the way that they grow, through acquisitions?
I really can't see that many acquisitions coming forward in the latter half of the year. If anything, the companies have repaired their balance sheets over the last couple of years. They're going to be desperate to try and protect the cash that they already have. They've gone through a lot of pain to get to the position they're in now, so they're not just going to go throw that away. You might see some deals, but I think you're probably more likely to see increased numbers of share buybacks. There have been a few announced recently, and Halfords in particular is one of those. Morrisons are buying back their shares in the UK, and I think you will probably see more of that.
We've also seen more US companies beat estimates than we have European companies so far. US equities in much better shape, and if so, why?
Certainly the US economy, and when you look at their GDP figures, certainly a lot better than in the UK. And I think maybe the analysts there are just maybe a little bit more accurate in their earnings numbers. Maybe they get a bit more guidance from the companies. But I think the US economy is actually kind of plodding along relatively well, certainly in comparison to a lot of other countries.
How big of a threat is this tussle that we're seeing, a bit more than a tussle at this point, between Democrats and Republicans over the US debt ceiling? What are the consequences if we see a default? What are the consequences if we don't see a default, but we do get a downgrade of the US's AAA credit rating?
It's a very interesting question, but I don't think anybody knows the real answer for that at the moment. It's the kind of situation where it's two children fighting in a school playground. You just want to bang their heads together and tell them to do a deal. Exactly whether one will be done or not is anybody's guess, but obviously markets have priced in the fact that the deal will be done at the 11th hour. But if it isn't, the US might not default on its debts per se.
You have analysts saying that if, an analyst from Credit Suisse, I believe, saying that if you don't get a deal on the debt ceiling, or this debate is prolonged for a few months, that you could see markets tumble equities by 15%. Does that sound like reasonable to you?
It's definitely feasible because it isn't really priced in at the moment. Everybody is expecting an 11th hour deal of some sort, whether it's a short-term deal and we'll have to revisit it in 6 months. That's maybe a bit of a likely outcome, but certainly a collapse in negotiations and no deal isn't priced into the market at the moment. Just
very quickly, have any of your equities moved from the buy or hold list to the sell list, since you've heard from companies?
To be honest, we've been taking a few profits recently, primarily in the small cap sector. We've made some good returns in NCC, which is a really good cyber security company. And we've also made some good profits on small cap mining stocks such as Zincox. So there are still profits to be made out there regardless of the market. And obviously investors are in this because they want a decent return on their money. So it's up to us to still keep finding these small companies that can still keep producing the profits.
David Lowery of Faraday Research, thanks very much for being with us.